So what I'm going to do is start off with is this, the 2017 farm income, and then sort of some ideas of what's coming in 2018, particularly on the cost side. And so we'll get started here. In brief, I got 3 main points. The U.S. farm income is up slightly in 2017, in Wisconsin as well. Projected costs for 2018 imply negative margins for crops, some of them, particularly corn and dairy, it's not as good. So it looks kind of tight out there, and so farmers are financially stressed. And so that's the short version. Let's get rolling here. This is USDA. It just came out at the end of November of 2017. This is the national agricultural farm income and net cash farm income. We'll look at net farm income, $63 billion, up a little bit, up 3%. It's the first increase in 3 years. That free fall we've seen seems to have stabilized. That's good news. This is cash receipts, not cost, just the cash, the money coming in. Crops here, corn is down. It's the 5th year in a row. It's actually not on there, but the 2012, it's just been down, down, down. Soybeans is down from last year, which is a big up year for soybean. Wheat is down. You can see the fruits and stuff are down. Vegetables are pretty flat. Here's livestock. All the livestock show a bump up in receipts last year in 2017. These are all the forecast. Again, came out the end of November. See, beef's up a little bit, dairy's up, broilers are up, or poultry, and then hogs. But what's down is government payments. It's been some tight years. You saw those income crashes happening over the last several years. There's some revenue support and price support programs that came out in the 2014 Farm Bill called ARC and PLC. They've given us some big money. You can see that big orange area there on the right side of the figure. That was those payments, and those have really helped farmers as their income is coming down. Those payments have pretty much slowed way down. They were down 1.4 billion nationally, which is a 17% drop, but they really dropped off here in Wisconsin. These are for crops, for corn and soybean, primarily wheat. They're down 71%. They were 202 million in 2016. This last fall, October, they only came in at 59 million in the state. So as income has fallen, and those payments have all of a sudden dried up, and they're most likely going to be very small next year as well. Looking at Wisconsin dairy cash receipts, you can see where we've been since 2010 here. And last year was up a little bit, about $450 million more coming in revenue to farmers. That's up 9%. Production's been up a little bit over last year, and the mailbox price has been up a little bit. So we get a nice little bump on dairy, which is very important for Wisconsin, obviously. It's our biggest ag commodity. Beef cash receipts are up again. That's following that national trend. They've been dropped off last year, but it's back up a little bit. About 3% is my forecast, based off of national numbers and then sort of the Wisconsin connection to the national level. Corn is down. Again, like I said, that nationally corn revenue has been dropping each year. And down about 50 million again in Wisconsin from last year, 4% drop. Acres harvested are down in the state. Yields were down. We had a record yield last year, so it's all, where do you go after a record yield? Usually down. So we were off down 2% in yields last year. Price is actually down a little bit as well, but it's primarily the reduction in overall production. Soybeans is down as well. Acres were up a lot, but the yields really fell off. We had a record yield in soybeans in 2016. So where do you go from there? Down. So cash overall fell there as well. What about cost though? That's the revenue side. This is just a start with the cost side a little bit. Cost hasn't changed a whole lot. This is the national index the USDA puts out. This came out at the end of November as well. Farm costs are just up a little bit in 2017, about not even 2%. The farmers have really cut back on anything that's variable inputs. If they can cut back on it, they've done it. They've gotten pretty tight. A few things have gone up. You can't control fuel costs, labor, interest costs are a little higher. So costs are going up a tiny bit. So revenues are up, costs are up, but overall farm income in the state has gone up a little bit. It's a good guesstimate for 2017, the year we just finished. Went up about 15%, about $250, $300 million, somewhere in that region from what we had in 2016. So that's good news in the sense we haven't kept falling. I always say things are, things are bad, or no, things are not good, they're just not as bad as it's not getting worse is the way to say it. Things aren't good, they're just, not getting worse. So what's been driving some of this? Let's go through the different cost inputs to crop production and agriculture in general. I'm going to focus on crops. That's my background more. Land values. Land is probably the biggest cost for crop production, rent, basically, or buying the land, the opportunity cost. Wisconsin land values jumped a ton last year, way higher. 9.5% is what the data show. Nationally, only California went higher, 10.1. All the states around us, Minnesota is only up 1%, Iowa not quite 2%, Illinois went down, Indiana down, Ohio down a little bit, Michigan flat. So we had a big jump in land values last year. It was only 1% in 2016. And so my inclination is dairy. We had a good year in dairy, and demand was there, and the dairy industry, longer term, the bets were we're gonna do fine. Well, higher land values mean higher rents. These are the rents for 2017, how they change. This is the average. NAS puts these out again roughly at the end of 2017. And this is by district. These are the district averages, how much the rental rates went up. So whatever the base is, which is on the next slide, this is the jump. And you see southern Wisconsin's about the same. 1% up or down, 2% in southeast, down in southwest. East central over there along, Brown, Kewanee, Gamey, all that area, up about 3%. But the real jump has been across the northern tier there. And I think that's really driven by those counties on the southern end of that northern district, Shawano, Marathon, Clark, Chippewa, Taylor, places like that, those counties. 12% in the northeast, 37% in the north central, and 30% in the northwest. Those are big jumps in rent in 1 year. These are the averages though. So these are the same numbers, now it's just the average. This is the 2017 average. So a $20 jump is what we had, and $16 and stuff like that. Well, on a base of only $70, $50, $60, $60, that's a big percentage change. But you can still see those are large changes to people up there. Land is relatively cheaper though. Across the south there, that's where the high value land is. The rents stayed roughly the same. You can see south central Wisconsin right around here. 174 is the high in the state. But the state average across all the state is about 117 an acre, which is up 9%, really pulled along by what's happened in those northern districts. Looking at the input costs, we're going to go through the inputs, the major inputs for crop production. Corn and soybeans. Corn's on the top there in blue, soybeans in red. This is University of Illinois' Northern Illinois data. What's really nice about them, they work a lot with the Illinois Farm Management Association, so they're good data. It's the same method over several years, so it gives you a good sense of what's going on. We just don't have anything like this in crop production here, this kind of data set. Nutrient expenses, fertilizer basically, is relatively flat, less than 1% change. Farmers have cut back on fertilizer as much as they can. Fertilizer prices aren't a whole lot different. Pest control, flat. Farmers are, again, nip and tuck. They've cut that system down as tight as they can go. Seed has come down a little bit, and I think that's not because the cost of seed came down so much as farmers have found ways to cut back on maybe buying cheaper traits or not even buying any of the traits, the biotech traits, or just maybe changing how much they buy, the seeding densities a little bit. Seed costs are down. Expenditures really about 4% for corn, a little bit on soy. Machinery expenses are down 3%. I don't think farmers are using less machinery. A big chunk of what's driving that is during the high commodity prices, farmers went out and bought a lot of machinery to help offset taxes. The machinery is depreciating, and that machinery depreciation slows down. We're seeing we're slowing down in the machinery depreciation out there, and so machinery costs are down a little bit, 3%. Well, you put this all together. This is, again, Northern Illinois data, but very similar to what we got in southern Wisconsin, where our major corn and soybean area for grain is. The blue is in the top figure. The blue line is the cost, the break-even cost in $1 per bushel, and the red line is a rough estimate of the farm level price projected for 2018 there. What you see is about a 75-cent negative margin. Each bushel of corn I grow, I lose 75 cents on. This is the full cost of production. This is the land paying a full, in this part of the state, it's about $2.30 is what the Northern Illinois average rental rate was. Their yields are a little higher, their rents are a little higher. Very similar to what I expect for Wisconsin, particularly across that southern tier. Losing money on the corn. Soybeans looks a little better, obviously. They're looking almost $1 per bushel gain there, a positive margin. The cost is below the expected price. So soybeans look good. They've been looking good for several years now. Corn hasn't been. Here's milk. I'm not just going to jump to the national number, or the Wisconsin numbers, but this is the monthly estimates of the full cost of production and the variable cost. And then the black line in the middle is the farm level price. These are all monthly prices, so they jump around. The last numbers there on the far right are the November averages, so you get a sense where we are at November, which is the most recent available. About a little less than $14 for variable input costs, $19 is the price, and almost $23 is the full cost of production. Negative margin, that's paying yourself a fair wage for your management skills. It's paying the full cost of opportunity costs for your equipment and assets. So it means in those situations, the farmers are working really hard to earn $20,000 a year, working 60 hours a week, or paying yourself not enough, basically, or making a very small rate of return on your assets, a negative return or just a 1 or 2% on a if you'd stuck it in the market, you would have made a lot more money. Below average rates of return. So as this capital has been drained due to these tight margins, which have been going on for a while, farms have increased borrowing. This figure is from USDA, and it shows the rise in borrowing in the last several years there. That blue line is non-real estate debt, operating loans. That's been pretty flat. The real estate debt's climbed. You look at the debt-to-asset ratio nationally, it's only 12.7%, which isn't too bad, you don't think. It's been going up each year. The rate of increase has slowed down. The last year it only went up 0.2%, but you can see those years before when the market was really coming down, that income was falling, it really rose relative to where it's been. And there's some indication where farmers are getting this cash from. This just came out on January 19th of this year. The USDA announces a near record year for farm loans. This is FSA. This isn't necessarily good news. The FSA is sort of the lender of last recourse. I was talking to someone once, and they said, oh yeah, we tried to get an FSA loan, things were tight, and we just didn't have any, we were trying to go things, and we go and talk to FSA, and like, no, you guys are doing better than, we can't give you any money, we can't lend you money, you should probably get it from the traditional system. And like, wow. This lending is up because people are having a harder time getting money from the traditional banks, and they're hitting FSA. Another place they've been hitting is some of the input suppliers, all the different companies that sell machinery or the inputs. Some of them provide credit, and some people have been moving to that as well because they get better rates, or they're just, their banks aren't giving them operating loans. So you see how that operating loan has been flat, so people have been looking for other places to get capital from. The one thing that I just found out about recently, yesterday really, and just been finding these information is Chapter 12 bankruptcy filings are really high in Wisconsin relative to the national numbers. This just came out this week, October 1st of 2016 to the 9/30 of 17, so just end of October 1st of 2017. This is all the list of states ranked if they have more than 5 bankruptcies, 5 or more. Chapter 12 is the farm, and well, fishers as well. I don't think there's too many fishermen or fisher people, I don't know, in the state filing for bankruptcy. But this is bad news. We're red there. That's number one. Georgia's got more than us. We had 41 in that time period. And the next, California's after that, and then Kansas is sort of the next traditional ag state. We're really high. And you can see this is a couple things I grabbed off of DTN, the Progressive Farmer Report, Chapter 12 on the rise. CoBank attorney expect more Chapter 12 bankruptcy filings in 2018. The one right below it is from a law firm up in Wausau. It's their blog, but you can just see it there from yesterday. Western District of Wisconsin, that's the Western Legal District, Court District, which is kind of the western 2/3 of the state. Western District of Wisconsin ranks first in the nation in Chapter 12 farm bankruptcy filings in 2017. So I was very surprised about this. Hope Kerwin from Wisconsin Public Radio has kind of clued me in on this, and we were talking a little bit about it yesterday. I gave the Wisconsin Farm Center a call and got some information as well. I took the data that was on those court filings and made a map out of it here. And so it's hard to see the light brown as one, but they're scattered around in this. Yeah, you guys can see them up there. I'm looking here. So you can kind of see those light brown ones are 1 bankruptcy in that county. The yellow is 2, the orange is 3, and red is 4. Vernon County has 4 bankruptcies last year in that area. We'll call them farm bankruptcies. There's a lot going on out there, and I talked to the Farm Center just to get a sense of what they've been seeing, and yes, farmers are very stressed. They're getting more calls, volumes are up. And these bankruptcies asked about that, and they said, well, it's conventional, it's organic, it's large, it's small, it's crop farmers or it's dairy farmers. There's no real pattern to it. I think it's been tight margins and a few mistakes or a few bad decisions or some bad luck, and you're in trouble. This came out last summer, was the media blitz on it. There's a CDC, the Center for Disease Control, had a big report on farmer suicides, comparing them to some other averages. And It's bad. Suicide rate for farmers more than double that of veterans, which, we've heard that much is bad as well. The press changes a little bit on it, but the report is older, but it's stressful out there. So farm income for 2017 is up slightly, but 2018 does not look too good, does not quite look as good. We'll hear from some more people about that. Another year of tight margins, especially for corn and dairy. Farmers have reduced variable input spending about as much as they can. Land costs have increased a lot, especially in northern Wisconsin. I think that's dairy. Farmers are still financially stressed. Some of us extension specialists put together this grain management considerations for low margin years. It's back on our table back there. It's a good 4-pager, won some awards with it and stuff. There's a whole playlist that goes with it. If you're interested, there's nice little videos to help with your growers if you're in the ag lending business. So thanks for your attention.